Okay, this video is going to go through how you find the daily bias using ICT concepts. It's going to be relatively simple, but there will be some good information in here even if you already are familiar with using daily bias. For the newer students, this will absolutely help you just get good at daily bias. It's an overcomplicated topic. Everyone wants to have their own little method. Well, today I will present to you another one. However, I believe it's simple enough that anyone can make it work. Even if you are an advanced student but you just struggle with the daily bias, this will help you. So the first thing we're going to do is we're going to cover stuff, not technical analysis, but things that you should absolutely know when you're going into the day and looking for a daily bias. Having a bias every day is unrealistic. You force yourself to see something that isn't there. And what I mean by this is you can't predict every single daily candle. Impossible. You can't. There's going to be times where you're neutral, where you're 50-50, or where you don't really know where it's going to go. And on those days, it's important that you just don't predict it. There's no point trying to force it into the chart when there's nothing actually there that's a salient point that you can actually make a reference from and say, I believe it's going to trade off this fair value gap and go into the highs. If you don't know, you don't know. You should not force it. Now, if you don't know because there's a lack of technical analysis knowledge, or if you don't know because it's at a point where it's more 50-50 and it's harder to predict, those can be distinguished between. Today we'll cover the technical analysis side. Daily bias is not predicting every movement of the day. Often you only need to predict one expansion. To put that simply, you don't need to predict the exact formation of the daily candle every time it's going to make a high or lower high close. The only thing you need to do is align yourself with one larger movement on that daily candle. So the daily candle, which direction is it going to go? Is it going to go higher or lower? If it's going to go higher, it has to manipulate some kind of sell-side liquidity or internal range liquidity, like a fair value gap. And it's going to react to that level and then expand in the direction of your bias. So if you're looking higher and you have a bullish bias, it's going to expand to the upside. That's the move you need to be on side with. That's it. You don't need to predict where the high is going to be created. You don't need it to go all the way into your high time frame objective. As long as it draws towards it, that is a successful daily bias. Daily bias does not need to be determined with a one-day time frame. Other time frames can be employed and should be employed. So when we're looking at top-down analysis, we begin sometimes on the daily chart. You should begin on a weekly, then go daily, then go 4 hour. That's all well and good. But when we're going top down, you don't only stick with top down. Once you're off that daily time frame, doesn't mean you can't go back to it. From that daily chart, you go down to a 4 hour. From that 4 hour, you go down to a 1 hour. But then you may go back up to the daily chart to confirm your 1 hour low time frame structure with that daily time frame. So you don't look at the daily chart and then think, this is my daily bias, and that alone. No. The lower time frame is essential because a daily candle is composed of all of these little lower time frame candles. That 1 minute chart, that hourly chart, that 4 hour chart, it's all inside that daily candle, all of it. So the information you get from those time frames will be salient and relevant and very useful. In fact, essential to determining the daily bias. I could not determine a daily bias only on a daily time frame. That would be extremely difficult and I'd be wrong a lot more. There is no mechanical way to find the daily bias. That's a false hope. Now you'll see YouTubers who give you these little systems and it's like, I use these highs, these lows, and then whichever one it takes, it's going to go into the opposite thing. That's not a thing. If it was, we'd all have algorithms that made us millionaires overnight. It isn't like that. Not even close. There is an element of subjectivity and experience and narrative reading that cannot be obtained from a mechanical system. That's not a real thing. There's no such thing as mechanical trading. There's no such thing as a mechanical bias. There isn't. Ever. I say this in almost every video, but in a lot of my videos, and for some reason people keep beating the drum. How can I do this mechanically? There is no way to do it mechanically. That's the hard truth. There is points of reference on that daily chart, on that weekly chart, on that 4 hour chart that we can use to aid us in determining the more likely direction. That's it. There's no 100% win rate. There's no 100% bias rate. There's no mechanical way of doing it. Key reference points when looking for the daily bias. There's a lot on here. And there's a lot on here intentionally so that you can have a lot of information, because for someone, looking at the previous 3 days high and low will be life-changing, but it may not be anything new for another person. But then the PD arrays we are trading inside of is a brand new piece of information for a newer trader, and then it can be completely changing for them. But you will not use everything in this. You will not use every single previous 3 week high and low, 3 day high and low, every single overall daily chart draw liquidity, every single PD array. No. The reason I've put these here is so you have a lot to pick from, but you only need a few of these. So you may just use the overall daily chart draws. So recently we were looking at an overall buy side draw on the daily chart, and it's been reached. But in the days before it was reached, we knew it was going to draw towards the upside on that daily time frame. So all of these daily candles have a higher likelihood to be bigger towards the upside. There can still be down close candles, but they should be a bit smaller, and there should be fewer of them. The up close candles, when it's overall drawing towards the buy side on that daily chart, are going to be more extended, because that's where it wants to move. It's resisting going lower to go higher. PD arrays we are reacting from. So if we're looking at a fair value gap and we've come out of that fair value gap, but it reacted to the upper quadrant of it, it didn't even use the lower half. That's a sign of strength and indicative of higher prices. PD arrays we are trading toward, particularly inefficiencies like fair value gaps, because those are porous pieces of price action and they draw price towards it. So a fair value gap toward the upside, if we've just reacted to an order block, a discount order block from the mean threshold, that's a fair value gap towards the upside. What is a low hanging fruit objective? That fair value gap. Okay, what's even lower hanging fruit objective? Because when we're trading intraday, that daily chart, yes, it may draw towards that fair value gap, but it won't hit it in one day most of the time. So what's an even lower objective? Maybe the high towards the right of the fair value gap, maybe there's a swing high, maybe there's just a previous daily high, maybe there's another point of resistance like an order block. PD arrays we are trading inside. So if we spend a day inside of a fair value gap, or there's a fair value gap that we've traded into on the daily chart, you grade that fair value gap, you get a lot of narrative from the gradients of PD arrays and wicks, and when we're trading inside of it, we can use the levels it's reacting to as an indication of how likely we are to trade higher or lower. So if it reacts to the upper half of a fair value gap, and you're seeing fair value gaps on that 5-minute chart form on the upper quadrant of that daily fair value gaps upper quadrant, then obviously it's more likely to trade higher. Previous 3 days high and low, you always need this, to be honest. Even if you don't want to have it annotated on your chart, you should at least know the levels, because those are the first reference points it's gonna use. Those are the 3 nearest objectives, those 3 previous day high and lows. You have to know those. Previous 3 weeks high and low, not as necessary, but you should still have something on your chart, because it's a more significant pool of liquidity, and those are going to be the larger price runs, which are the price runs you want to be a part of. Okay, we are now on the chart on NQ1. So this is the continuous contract, so it's going to look a little bit different to the NQH that we're all using, because that is the March delivery contract. So you can see we've been in a range-bound condition since December, really. Now we're starting to leave that condition, which is a good thing, but when we're in conditions like this, even on the daily chart, you may find yourself in consolidations. Look at this, that was a consolidation. Look at that, it's a mini consolidation. This is a consolidation. It's range bound. It's refusing to, displace significantly towards one direction or the other. What do you do in that case? You just go in without a daily bias. You trade with that one. You don't need it in that case. Now, you can still tap dance your way around these types of markets, and you have to kind of tiptoe very carefully. Where are we drawing to? How are we going to get there? And then you have to account for the fact that there's going to be less likely to be like nice distribution in the price action. You have to just know we're consolidating on the daily chart. It's not as likely to play out towards this buy side liquidity because we're range bound. To break that, it's going to take quite a large, amount of steam and energy from the market. And to see that, you need, a candle that breaks out the range. Does it break out here? No. Tests the level, takes out the buy side, and then rejects it. So when we're in these consolidation conditions, it's extremely difficult to navigate. You can if you're more experienced, and we were doing this in Private Mentorship, but don't push it on times like this. These are the very, very difficult times to be in the market. Even if you're trading intraday without a bias, it can be very difficult. So trading with a bias can just put you in, it cause you to marry a bias. Say on this day you were bullish looking for this fair value gap to deliver, you would have got a huge price from there, but then from this level, say you were looking at it to keep delivering high into that, and you marry that idea because it looks like it's really significantly reacting to that suspension block, it's going to start rallying, and it doesn't. Why? Because we're in a lower probability stage on that daily chart. But there's going to be times when we're in consolidations, and there's going to be times when we're in nice one-sided deliveries, like here, 2025, February, we had this really nice, clean sell-side run. And how do we identify something like this? Well, those points of reference I gave you, those are for predicting the next day. So if I'm looking at this individual candle and then it's 25th of March and I'm looking at the 26th of March, where's this candle going to go? I have to use those reference points. But to figure out the overall draw on liquidity from the daily time frame, you don't need all of that stuff. You just need the regular technical analysis that you do on even a 1 minute chart. So here, what have we got? We've got this liquidity void, which is a new week opening gap. It trades up into it. Then, what's this level here? Relatively equal highs. Sweeps the relatively equal highs and rejects the new week opening gap. We have sell side draws here to the sell side. So already this is a formal 2022 model. Rejects liquidity inside of another PD array, runs lower, leaves a breakaway gap, which is a sign of weakness, breakaway gap, because it fails to leave that gap after creating a market structure shift. That is a market structure shift. Leaves another fair value gap open. And imagine you're at this point now. There's a fair value gap here. And you think, okay, I want to see it trade up into the fair value gap to start running lower. Well, from this day, 27th of February, when it fails to run up into that fair value gap, after it fails to take out the previous day high, what should be going through your mind now? We have a lot of sell side draws, and it's failed to take or to run up into these breakaway gaps. But it has traded up into this new week opening gap, aka that daily chart's liquidity void. It has taken out the relatively equal highs and it's broke lower. It's given me a market structure shift, left all these signs of weakness in the chart, and there's sell side draws. The only thing going through your mind here should be, okay, it's looking for lower prices. Now this is a daily chart. Is there anything different from this chart to the 1 minute chart, the 5 minute chart, the 10-minute chart? No. It's the exact same technical analysis. That nothing changes. It's fractal. So that model you use on your 1 minute chart for, even if it's an entry model, like you expect after a market structure shift, it's closed through, it leaves a breakaway gap. What's going to happen? It's either going to trade up into the fair value gap and reject it, or it's going to leave the fair value gap open, which is even better than if it trades up into it, and then reject it even stronger. Because if it's not trading up into the fair value gap, it's even weaker and it's going to move you even faster. So from this point onward, you would have been looking for purely sell side delivery. But even on these candles, it gives you this expansion lower. So if you look at this, this is an up close candle, correct? Yes. But then at some point in this candle, it still expanded to the downside and it met a sell side objective and then it traded back up. So there's still room for your daily bias of sell side delivery to be exercised there. Okay, here's a different chart example where we already know the overall draw, but we're not going to even refer to that because that may not be your cup of tea. Predicting the daily chart may be more difficult for you, and that's fine. It will be more difficult for some people. That's nothing to be ashamed of. It will come with experience and time. That's how it works for everyone. No one's immune to that. No one can get around that. It will take time and it will take experience and doing it and journaling it. And unfortunately, that's just the way of this industry. And the way of any industry, really. Everything will have to take time to learn. But when I just gave you those pieces of information earlier that you can use on the daily chart, when you're predicting just one candle, let me show you how easy it is. So clearly we're trending lower. From the daily chart, you can see it's trending lower. It's in this fair value gap. So you might have been thinking, okay, from this fair value gap, I want to see it rally. Here you get two up close candles. It takes out this high here, the 30th of August high, and then it slams lower, inverts the fair value gap, this one, in case you're having trouble seeing it, inverts the fair value gap, so that's a sign of reversal, and it creates this fair value gap. So this is a bearish order block now followed by a fair value gap. That's a very strong level. What do we know about bearish order blocks that follow fair value gaps? They're super strong. A bearish order block followed by displacement, aka a fair value gap, is a very, very strong PD array. Now, I'm not saying you have to predict the 4th of September. You might have been neutral on this day, because in that bullish fair value gap, but it's just made the inversion and it's coming out of that bearish order block. Say you were neutral. Cool. That's fine. You don't need a bias every single day. Completely unnecessary. What about the 5th of September? the 5th of September, it comes out, it takes out the previous day high, so this is the first daily high, and the first daily low before the 5th of September. What's the next one? Well, this is another daily low, so this will be the second daily low, but we don't need to refer to this because it's already taken out. That's the next daily high. That's way too far away from price. We're not looking at it too closely. The next daily high would be this one, the next daily low would be this one. These are already swept, so we don't refer to those. So if the liquidity is already swept from a daily low or the daily high, you don't refer to it because it's not a draw anymore. It may retest that level, but it's not a draw anymore. So on the 5th of September, it trades up into this PDRA, this fair value gap, and it takes out the daily high. Because you were working with limited information, but even with such a small amount of information, you can see how you would have been able to predict that. Because what is it going to refer to before anything else? Before anything else, the previous day candle, high and low. That's the first one. It's going to refer to the high, it'll refer to the low. Before it can react to that high, or this fair value, or rather, like that bearish order block, it has to go through this daily high and this daily low. So the very first levels you look at are that daily high and that daily low. The first ones absolutely has to do this. It's just logic. To go up, you have to reach this level. To go lower, you have to reach this level. Make sense? So the first point of information has to be those daily highs and lows. What's next? Well, which fair value gap or which PDRA are we reacting from? There's that inversion fair value gap. The reason I don't have it on the chart is because it's going to make it a bit messy. But the inversion fair value gap here, just like that, it's reacting to it because it's traded down below it, displaces through it, and that's a sign of reversal. So that's more context. That is probably weak. Bearish order block. If a bearish order block is super strong, it doesn't need to react to the opening price of it. It may react to the low of it. So when we include the wicks on an order block, can be like this, you may include the wick here because it's super weak. What does it do? It trades up into the fair value gap, institutional for entry drill, and look at the low of that bearish order block. Just goes a little bit beyond it. So that's bearish. It's a sign of weakness because it doesn't have the steam to run all the way up into the fair value gap and start basically showing you it can reverse back higher. It doesn't have the will to do that. Instead, it rejects and the candle closes down here. So what of the next daily candle? What would you do here? Well, you would look at the 3 previous day lows and the 3 previous day highs. So that would look like this. We have this high, daily high. We have this daily low, still the same. It trades up, barely goes above the body. This is important because this is a long wick. You grade this wick. Now, this isn't beginner friendly, so if you're not comfortable grading wicks, you don't need to acknowledge this part, but it doesn't really go into the wick at all. It just rejects that lower, that very, very low of it, pretty much. That's a sign of weakness. On daily chart, you can use even stuff like that. Now, that may be over-analyzing it if it was done on a 1 minute or a 5 minute chart, but on the daily chart, you can absolutely do that. And then we have a draw to the downside. We have this low, we have this low, we have this low, plus this volume imbalance. And because we have all these signatures of weakness where it displaced lower, reacted to that bearish order block, the inversion fair value gap was created and run through, immediately doesn't refer back into it, just breaks away from it. We have all these signatures that indicate, okay, it's most likely going to run lower. So if it's going to run lower, the first reference point would be this daily low. And the reason I haven't put on a separate line for that daily low, because it is slightly different, it's just because I don't need to. It's relatively equal. It's only a couple handles different, like that. There's no point. Be logical here. Use some common sense. If it's going to run lower, what level should it refer to? The daily low. Now, it can refer to the daily high and then take out the daily low in the same day. I'm not saying that can't happen. But if it's heavily bearish like this, where it's giving you all these signatures of strength and weakness, primarily weakness here, and failing to be strong, it's showing you it's weak, then what do you expect? It's going to trade lower. Okay, then this is the PDRA it runs into, and you can see the body barely leaves it, and then it starts to rally higher. So now we may be in a stage of, okay, this wasn't an outright reversal lower, this was just a retracement lower. So if it's going to trade higher back up into these relatively equal highs, so that would be my overall draw. I may consider it like this. This is low resistance liquidity. It wants to trade up into this. Okay, what will it refer to first if it's going to do that? Well, when I start to see displacement occurring from, say, this day, I know that we have this fair value gap here. It needs to invert the fair value gap. So to invert the fair value gap, it should trade up above this high and close above it. If it closes above it, it will not affect your bias because your bias has been successful when it trades up above it. You don't need the daily candle to close for your daily bias to have played out. Because remember, we're not predicting the open, high, low, and close. We're just predicting one expansion level. So from here, there's not really a daily high or low that you can use other than this daily high. But that's met pretty quickly. You wouldn't have really had a huge amount of access to that level. So then I'm looking at the PD array that we're trading inside instead. Remember from earlier? Now what else may I use? I may use a weekly high or a weekly low. So here on a weekly chart, forgive me for it being a little bit messy, but that is previous third week high, and because we're using since we can just look at this one as well. So we know the likelihood is it's going to start drawing towards this upside here. So if you're looking for bullish days, because it's going to draw towards the upside, it breaks through the fair value gap, makes this an inversion fair value gap. That's an inversion fair value gap. An inversion fair value gap performs the best when it doesn't trade down into the midpoint. If it stays in the upper half, that's better. So it reacts to this fair value gap. So this would be another PD array you look at. There you go, just one. Fails to reach the low. That's good, because if it colors the entire thing, it may not be as strong as you want it to be. But it fails to reach the low, and then it rejects it. The body closes all the way up, a little bit above the fair value gap. That's great. You see this volume imbalance? This is actually new day opening gaps, but like the new day opening gap would be like that. The volume balance, however, is like that. So that's the volume imbalance. Another PD array that you're trading inside of. And then on the day you're trading inside of it, trades down to the midpoint, trades up into that weekly high. And you can start to see it. Now, say you're looking at the 18th of September. What's the previous daily high and the previous daily low? It's this low. And it's this high. This one, I'll remove that. I will. So the previous day sweeps that weekly high, and then the next day, say you're thinking, okay, well, the candle took out a level of liquidity on that weekly chart, and the body closes all the way down here. So maybe you're thinking now, okay, we've still got the volume balance to work within, but I'm not super sure on the bias. Okay, well, which levels will they absolutely refer to? The daily high and the daily low. Which one is it more likely to take out? Well, we're leaning overall towards the buy side, so the daily high. That's the level it should expand more in favor of. But even if it wants to take out the high, it can take out the low first and then go to the high, which it does here. And the next candle opens up down here, only a very small new day opening gap, and then it runs up into that weekly high. So when you're looking at the daily chart and you're determining a daily bias, notice I haven't even needed to go into the 4-hour chart. You have to look at a very zoomed in perspective. You don't need every single piece of information, but the pieces of information are very simple. Where are those previous 3 daily highs? Maybe look at a couple weekly highs, look at a couple PD arrays. It shouldn't be complicated. It should just be, where's it drawing towards? And then go lower time frame, does that support it? So is it supported on the 4-hour? Is it supported on the 1-hour? The same thing that I just did on the daily chart, you do this on the 4-hour, on the 1-hour, and that should help you determine where it's more likely to expand towards. Now this is a really beautiful price action. If we're in a condition like this, which is where we're currently on the daily chart, then of course you wouldn't really want to try and predict this. Now we were predicting this, and we got most of it correct, because I was doing that each individual day process, looking at the previous 3-day levels, looking at the fair value gaps and the order blocks and any PD array that we're trading in, and looking at where we're reacting to, looking at where we're trading inside of, where we're trading towards. All of that can help you navigate these pieces of price action, but if you're a beginner, you don't need to do that. You can just be content with waiting for really clean pieces of price action. So here when we take out this low, right here, it rejects the level, gives you volume bounce to the upside. That's a nice indication that it's going to keep displacing higher. Displaces higher, trades lower, fills immediate rebounds, runs up again, and again, and again, retracement day, and again, and again. Bit of muddiness here, but it's still acting on that bias. So the entire point of this video is to get you to understand. You should look at where you are drawing towards, at that daily chart, at that weekly chart, at that monthly chart even, the 4-hour chart, the 1-hour chart. That aids you in predicting the current day. You don't need to predict every single day, and you don't need to predict the open, high, low, close. Just one direction on that expansion candle, and you're good. That's all you need. That's it. That's literally all you need. Okay, well, thank you for listening to this video. Hopefully it's been an insightful one. And you'll notice that these are not systematic, mechanical approaches. That's because those don't exist. You have to use nuance. You have to use context. These are a process that requires some experience, and it requires some doing. There's no little trick I can give you. There's no checklist I can give you where you just check it, and it's done, and that's all you ever need. That doesn't exist. I'm telling you, there's no way to do that systematically and be profitable. It wouldn't work. It just doesn't work. You have to be able to look at the chart. And I'm not saying you have to magically know it with your intuition. I'm saying that there's an element of subjectivity. Like displacement. There's no specific handle amount for what a displacement is. There's no specific, how far does it go? And that's considered displacement. There's nothing like that. There is an element of subjectivity there. Which fair value gap is valid? Well, we can look at how big is a fair value gap. That's an element of subjectivity. To me, it may be considered valid. To someone else, it may be considered invalid. So trading has these elements of subjectivity, and unfortunately, there's no way around that. If there was, everyone would do it, and everyone would be rich from it. There's a reason only 1% succeed in this industry. Because it's hard, because it's difficult. But that's the point. If it wasn't hard, it wouldn't be worth doing. Okay, well, thank you for listening. Hopefully it's been an insightful one, and I'll see you in the next one. Goodbye.